Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, January 25th, 2021. Um, Quite a few things I want to point out, but it won't be a long video. I just want to mainly look at the indexes and kind of just talk on what's going on right now in the market conditions, and what to watch for. Now, as you know, forever and a day, been waiting for some sell signals in the market. The trend is up. Randy, why you want to wait for sell signals? And again, when a trend is up, you can go long anywhere you want. There hasn't really been many objective long entries lately, because when you're at all-time highs, you don't have any resistance levels, and there wasn't any type of continuation patterns. That's the two ways, well, three ways you can go long or find an objective long entry. You can wait for a breakout above resistance. Let's say market's been bouncing at one level for months, and consolidating and finally broke out. You can also wait for a pullback to support, or look for some type of continuation pattern, like a bull flag continuation pattern, none of which we've had here. We've just had a steady drift higher, and as mentioned recently, I give you some new uptrend lines from the March lows that now are pretty valid. So that's why, well, one of the reasons I want to do the video. We're darn close on the S&P 500, and that would be one sell signal, certainly a sell signal if we break this trend line, especially if it's very impulsive, and if we have as well as a solid close down below it. So that's SPY. I think you can see the trend line there. We pretty much kissed it at today's lows. In fact, when I zoom in, sometimes you have to tighten these lines, shift a little bit, but there it is, pretty much at today's lows. Comes in, captures these candles back here, the body of that candlestick from October 30th, and the shadow, the skinny part from the previous one, October 29th, and the one after there as well, November 2nd. So that's really a pretty decent trend line. And then QQQ, similar trend line, again coming off the March lows, and the Qs are a little bit comfortably above it. Now I want to show you a few things, and again talk on trading opportunities. That's a setup on the markets. We have a short setup. The trend is long. There's no sell signals, but I'm going to go over kind of everything. And what I want to talk about on QQQ, and I have recently, I've gone over the FANG stocks and levels to watch. I color-coded all the key levels in yellow, and we're above that. All those, Microsoft, Amazon, this is Microsoft, that previous one was Apple. We're well above those important support levels. And this one now, we have enough reactions, I can even color this one up. I don't want to make it like a Christmas tree, but let's just give it a different color here, because that gives us a symmetrical triangle right here in Amazon. What I wanted to point out today, we had a pretty nice intraday reversal. For many months, some of the market-leading FANG stocks had stalled out, and a lot of them were lesser tier names, smaller companies taking the leadership and rallying, whereas Apple, Microsoft, Amazon, like I just showed you, Amazon in a big triangle pattern, has kind of floundered around. Apple, I want to put a line right here. Somebody asked me today if Apple broke out. And here it is. You have a trend line right here, or a horizontal line right about 138, and what that is are these two previous reaction highs right there. Major reaction high, obviously, and that one also a pretty important reaction high, because we had another failure. And so what today is, it's a breakout. And breakouts are bullish, as I always say, until and unless they fail. So that's what we'll be watching for. We still have a big level here, about 125.75, and it is a breakout. Take it on face value as long as it lasts. Not a breakout I care to take. There's much better fish to fry elsewhere. I'll get to some lows in a second. And if you're bullish, then there's nothing wrong with taking that breakout. You just want to have a stop a little bit below 138. You don't want to have it at 137.99. A lot of times when you break out, even if we rally a little more, you come back in to test the breakout level, and it's actually pretty common, and more often than not, you're going to undercut it a little bit. They like to run the stops and then go up. So where you put your stop, again, 135 sounds good, somewhere in there, if, again, you're going long. Now, the reason I don't think the breakout's going to last very long Well, there's a lot of reasons, but one of those is the chart of Apple. We continue to build big divergences. These are the largest divergences that I've seen on the stock on this daily time frame in many years right there. I just drew them out. Last time we had a divergent high on the daily chart was right here, and it doesn't look like much because I use log scaling, but I'm going to measure that drop for you. That was into the March lows. That was a 36% drop. So that, call it small divergent high. I'm going to get rid of this line right here. That one really shouldn't be there. There's our divergence line right there, a little trend line, negative divergence, overbought conditions, and boom, 36% drop. And each of these, I used to measure these out in the past, divergent high. You can see all the drops, average. Well, they were all into the double digit range, 13%, 17, 10, 9, well, that was close, 12, so forth and so on. And again, this one was a lot higher. It's not measured out, but that's about a 40, almost a 40% drop there. Okay, so you get the point. Biggest divergence in many years. This divergence shows through all the way out to the weekly chart, and that's where your bigger tops. When I look at the weekly chart for more of the trend, this is trend traders would really hone in on the weekly chart. Swing traders, and I wear both hats. Swing trading, I look at the 60-minute charts to hone in on my entries and exits. Sometimes even shorter term time frames, and of course the daily charts too to help identify price targets and key levels. And this is our long-term chart Apple. You have a long-term trend line, which I believe will be revisited at some point, probably in 2021. It would be my guess. We'll see. But as of now, like I said, we don't have the sell signals, but we have those same conditions. And history doesn't always repeat, but it often rhymes. So you look for these divergent highs, and again, the big ones, 45% drop, 34% drop, 39% drop, 35% drop. And if this one doesn't, sooner or later, and that's the thing, these divergences can build for quite some time. They can continue to build for months. In fact, we have such steep divergences on Apple that at no point anytime soon can those divergences be taken out. So I may be talking about Apple 3-4 months from now with just much larger divergences, and it could go a lot higher. So again, I just can't reiterate this enough. There's a big difference between pointing out bearish developments or potentially bearish developments on a chart, just like I talk about the difference of trade setups and an actionable trade. And this would be a setup. What we don't have here is a sell signal. Stocks that made an all-time high today. That's anything but a sell signal. What would be an early sell signal? Well, to see it clearly come back down below 138, and then to break that 125.75. And I pick on Apple, I'm highlighting Apple, I should say, because that's the world's, the largest stock here in the U.S. and largest stock in the S&P 500, largest stock in the NASDAQ 100. And if Apple broke down, most likely the rest of the tech sector would be falling along with it. Okay, so that's one of many things to watch for. Watch those trend lines I gave you on SPY and QQQ. And just one of the many other charts I'm watching here, and I've been covering a lot lately, and it just continues to flash some pretty clear signals. I'm a little averse to calling them sell signals. I have this, buy line and sell line, the green range. When you get up there, you have extreme bearishness fear, and that's when typically you want to buy. But I always caution, especially on the downside here when you're in a bull trend. Usually the corrections, it's often a one and done thing. In other words, I'm circling when we had those spikes, and that's when you want to step in and buy. These were the best buying opportunities in the last several years. You can see that, this goes back to 2015 here, and we only hit that level a few times. Likewise, some of the best shorting ops or time for you to get out of longs. I completely am aware that the vast majority of people listening to my voice don't like shorting. They're not comfortable with it, or it's a bull trend. Why look at shorting? But you just sit back and wait patient, and the nice thing about it is it's very, very often that usually months and sometimes years of gains are wiped out in a matter of days or weeks when you have these corrections. That's just the nature of correction. Stocks tend to fall much faster than they rise. So, if you don't get out in time and you wait for Kramer or whatever it is you're following to say we're in a correction, that's usually when the darn thing's over or close to it. And again, you can go back, and in this case, years of gains were wiped out in just a matter of weeks or months there, and of course there as well. And now where I'm going with this, I realize that I do these videos and you might not be able to make out all these levels. So let me zoom this thing in here a little bit for you and show you what we're doing here on the on the put to call ratio. Let me move this over. Still not in the screen. 1 second. Okay, there we go. It can be hard. My main monitor is a 43-inch 4K monitor, so it has, a little tiny, relatively small part of that capturing these charts, and I have to squeeze them and move them over to get them into the screenshot area. I can't record all that monitor. It would just be too much too much resolution to try to record and upload to YouTube. So here it is. This is the CPCE, and continues to just pound these extremes right here. And again, this is one of the most reliable indicators I have for corrections, and it's not the only one firing. And as I've said, and I've said it repeatedly since we first started falling to here, sometimes it's one and done. You hit that level and the correction follows almost immediately or very shortly thereafter. And at other times you have persistently low readings like this, and that's been the case here. If from this, if we don't have when I say a decent correction, I'm talking, a minimum 10%, and I'm thinking much likely 20, or much better, probably 20 plus easily. If that doesn't occur, it'll be the first. And here's the thing: not a timing indicator, nor is it guaranteed. There are instances you go back on any indicator, they work for many years, and all of a sudden they don't work. So, unfortunately, there are no guarantees. If there were, you just put all your money in long-term puts right now, go out 6 months to a year or more, and you'd be guaranteed to make money. That's not the case, but I can tell you, I would put the odds at about 90+% that this is we're going to get a correction now, and it's going to be imminent. We hit an extreme, saw it in the journal just the other day. So in the last week or so, we had the highest volume ever, the biggest day of call buying. And again, the markets just, they don't reward that kind of excessive bullish sentiment or bearish. When everybody's on one side of the trade, the market will correct that. It just doesn't allow easy money for too long. So be cautious. Now, with all that being said, somebody mentioned something. I did an update today on the homepage. You probably saw it on a couple of the trade ideas that I mentioned in Thursday's video last week. HSTO was one of them, and the comment was, "Oh, going into penny stocks now." Actually, this wasn't the penny stock, but this one I'll update. Broke out on Friday. There was your buy signal, and it continues to move today. So, I'll continue to post these, and you can take them as you want. I gave you another potential target there, 167's resistance. You want to sell a little bit below that, as long as the music continues to play. And the one I think the comment was on is SPHS. It's a penny stock. And as I said in there in the video, extremely speculative. Now, over the years, I've posted quite a few penny stock setups. Now, they're a very, very small percentage of the trade ideas. The main focus of this site are large cap stocks, or I'm sorry, not large cap only, individual stocks, mostly everything but penny stocks, small, mid, large cap, futures, ETFs, sectors, commodities, things like that. And however, if I see a chart that's bullish, I'll point it out. I'll do my best to impress how risky and aggressive these are. And I often talk about putting Vegas money here. You're going to go to Vegas, you're going to put whatever your number is that you're willing to lose, and that's fine. And that's what you do with these guys. And I can tell you, more often than not, they pan out. And so this one broke out again on Friday, and now it's up about 237% since then. And since the update this morning, here is your second additional buy signal. We took out the 0393 level, and that leaves that big gap to be filled. So and then finally, what I said in there at the end of that comment that I replied to is when in Rome. And what I said is right now we've been in a risk on environment. That means bonds have been being sold off. They are risk off assets. Gold's been weak. That's a risk off asset. It's a risk on market. And so again, when in Rome, do as the Romans did. And so you may not, believe me, this is not anything you want to put in your IRA or 401k and tuck it away long term. Penny stocks usually or most often, a lot of them end up going to zero. They file for bankruptcy protection, they get delisted, they go away. But again, it's I always use the analogy. It's like instead of looking, going on a dating site like Match.com where you're looking for your next, spouse, your future husband or wife, these kind of things are Tinder. You're going in for the quick hit and run. You get it, get in, get out. Get your 100% that first target, or swing and hold out for the as long as the music continues to play, because that's what people are looking for now. They're going for these lower tier, higher risk stocks because there's no fear in the market. And again, it's a momentum trade. That'd be about a 917% return right there. 9 times on your money if that target is hit. So finally, if it's not your cup of tea, pass. Don't trade penny stocks if you don't understand the risks, or if you're not, comfortable with, or familiar with how to, diversify and, not put too much money in any one position anymore in that particular stock more than you can afford to lose. Apple, that's not the case. Apple's not going to go to zero. You're not going to wake up tomorrow with a bankruptcy filing and then Apple stock down at zero. That other one you could. And again, I haven't even done any due diligence. I'm just telling you it's a penny stock. And now there's another one, Y10, like buy signal above $7. It continues to run. It's not a penny stock, but it's the risk-on environment. So far, we're good for about 168% since the $7 breakout. And then I said the next buy signal will come above 842. And if you took it there instead, well, you're still up about 120%. So as long as the music plays, meaning we're in this risk-on environment where fundamentals don't matter, people are looking to buy anything that's, starts to move and then gets picked up in those little chat rooms, the Robinhood groups, and what's the other one, Reddit or whatever, where all the traders, can chat together. That's what they're buying. And when the music stops, these stocks will collapse. They will be down. Many of these, especially like the first one I covered, like Histo, those things will drop 50% or more in a day. I've seen it time and time again. So the key is engage while the music's playing, but don't be the last one standing when the music stops without a chair. Okay, other updates, things I've been highlighting recently. The euro. So far, the euro has turned down right in the middle. I give a bounce target range here of about 120.153 up to 122.36 with a midpoint resistance line right there at 120.194. And so far, that's capped the rally. Now, so far, and we did have negative divergence as well. And so I still favor more downside, but we need to take out these two previous reaction lows. That will open the door for a drop to my third and final, at least near-term final target zone there, T3. If that happens, that should put pressure on the dollar-sensitive assets, which include the stock market. It's had a high correlation with the euro and the dollar, crude oil and all that. So let's talk on that real quick. Just again covering trade ideas here. Crude oil, here it is. Crude broke down back here, topped when the euro topped same day, not by mere coincidence, and put in almost equaled that top. That was the high right there, and broke down here. And so this chart, not by coincidence, looks like the euro. Here's some reaction lows. We need to take those out. So if and when the euro takes out those previous reaction lows, crude will probably do the same. And whether you trade crude oil direct, you can use that CL, which we were just looking at, crude futures, or you can go with USO or one of the, I think there's some inverse ones still out there. I know some of the inverse crude ETFs or ETNs blew up back here. Means they went to the wayside. But there's also, as you guys probably know, my favorite is the energy sectors. You can use XOP. And what I did is I added a trend line here on XOP now that we have a third reaction. And so it gives us this rising wedge pattern there. Just, a couple reactions back here, another reaction there, and another reaction there. So here's a bearish rising wedge pattern. And there's our trend line. So this most likely will break on or around the time, especially if the S&P 500, that trend line I give you on the S&P 500 breaks. They are different trend lines, but they're both in close proximity. And then we have just below that the 6350 target or support as well. And if that breaks, that could bring us down to the back trend line back test or right there. So that's XOP. And if you can't short, or you just want to buy a ETF that'll short for you. That's DRIP, covered many times recently. And same thing. So to watch, this is a line I gave you last week. This resistance, we broke the downtrend line, but we were at the uptrend line on XOP, and that's more important. So in other words, that XOP uptrend line takes precedence over this downtrend line on DRIP, because DRIP is 2 times leverage, so you have some decay. So when you go back longer in time, the farther you go back, the more inaccurate it renders these trend lines, depending on, as far as how they align with the sector ETF, if that makes sense. XOP being the sector ETF, the one time tracks the same sector as this DRIP. But these price resistance levels hold true right there, and boom, because that's more near term, and that's what we need to pop. And so far since last week, since we hit it there on Friday, we're at it. So this is what we're looking at. If we can get a breakout here, that should be the catalyst for a move up to that first target there. Oops, right there, about 2288 or so. And then this is what XOP looks like. I gave you the 60-minute chart, same thing. So again, this trend line is more significant because this is the non-leverage. This is the actual sector. And so there it is. Plenty of reactions. 1, 2, 3, 4, now 5, 6. And that's it. We need to break that, take that out, come down, hit 63.71, probably get a bounce off there, maybe a back test, maybe not, and then a move down to this final and near-term preferred swing target of 57.17. That still gives us about 15% downside if hit. But if it happens the way I think it will, with a pretty quick rush for the exits, instead of getting 30% to my comparable target here, because of that leverage, you get about 42, 43%. That again is the comparable target. That's T2, my preferred swing target on drip. Talked about that quite a bit. That leverage works against you when you're in a choppy sideways trend holding these leverage ETFs, whether they're long or short. But it actually works in your favor. In other words, you get better than 200 or 300%, whatever the leverage factor is, if you get a pretty quick, what I call unidirectional trend, meaning a rally without a lot of kickbacks or a lot of pullbacks along the way and consolidation periods along the way. And last but not least, just to kind of loop back to the indexes, there's IWM still hanging in there. This is a daily chart. It's a price channel I gave you recently. We need to break that price channel. And if you zoom down to the 60-minute chart, I had this wedge type pattern, which we did break down. We back tested today, and all that did is extend. We put in a marginal new high, still a divergent high. So what we need to see on IWM is a little more downside. Again, you won't see that daily trend line here. I can replicate it for you. It goes back a little farther. The price channel, the price channel. It's actually, you know what? It's the same trend line. There it is. I already had it here. It was this trend line I had back here. We had that one little whipsaw down through it, and so that's it. So we pretty much need to take out the recent lows. Friday's lows on IWM should do the trick, and then what you'll also want to look for is the PPO down below. You want to see that cross down below the zero line, make a solid cross. That would put you on a bearish trend like you had back here, here. As of now, it's above the zero line, which keeps the trend bullish like it is when it's above here. And that does it. So to sum it up, equity markets remain solidly in uptrends without any sell signals yet. Indicators, and I only hit on some of them today, all the sentiment, AAI survey, bullish sentiment is through the roof. And the thing is, that can continue for quite some time before it manifests in the form of a correction, but it usually does. I'd say almost always. Unfortunately, there are no 100% guarantees in trading. Sometimes you can have those periods of bullishness, and and the market can continue to rise for quite some time, or it may correct sideways and not really give you that correction. But again, go back in time, 20 years plus. When you hit these extremes, usually you do get a sizable correction that follows. So, like I said, right now, you can trade long, look for the most bullish setups like those that I've been trying to share recently. I'll look for some more, and if you want to start hedging it up, or you're diversified, or even just a pure play short, look for the most bearish sectors. I mentioned energy, XES, XOP, XLE. There's XES, sell signal right there, breakdown. That's then the oil and gas equipment and services. Probably target right there, 44.22, the first target. That'd be a drop of about another 9%. And again, that's a minimum target. I mentioned financials as one of the more bearish setups in the S&P 500. Had come up to that big 31-ish resistance there with a divergent high, and it's already rolling over. So again, if you want to start shorting, probably better to, well, I can tell you, my preference is to short the most bearish sectors and bearish stocks that have clearly, bearish patterns and or sell signals, and if not a sell signal, at the very least an objective short entry with a rally up to resistance. Then you can put a stop somewhat above, and next sell signal comes on a break of the trend line I just gave you there, plus that 29.88 support just below on XLF, the financials. And then if you start to see these sectors break down, like energy is already reversed, the financials, that will usually ultimately permeate into other sectors like tech, which right now is having a good day recently. All right, I'll wrap it up here, get the video out to you guys, and then I'm going to spend a little time looking for trade ideas today. And just to let you know, I'll be out tomorrow morning. I have a dentist appointment that might run for a while, so when I get back, I'll follow up from there. This has been Randy Finney with Right Side of the Chart. Have a great day.